Island reversal. Before we understand island reversal, let's first understand breakaway and exhaustion gaps. A breakaway gap has a downward momentum and the stocks can suddenly dip below the support line. This gap between the support line and the dip down. Now this is due to a change in psychology and people start to sell their shares. Exhaustion gaps, on the other hand, can happen when the price of the stock shoots up, jumps, and then continues the upward trend. They can also happen when the price of a stock declines, jumps down, and continues a downward trend. Now, you can identify an island reversal when you see an exhaustion gap and breakaway gap at the same price levels. Let's consider bullish island reversal. To identify a bullish island reversal, you will first see the price of the security fall with a down gap. After the price falls to a certain point following the down gap, the price will then consolidate at around the same level for a period of time. Finally, the market gaps upward to break the resistance line that was formed when the price initially started falling and then reverses the bearish trend. In this scenario, you should consider taking a long position in the market. In a bearish island reversal, the price of the security first rises with an upward gap. Similarly, after rising to a certain point following the upward gap, the price will consolidate at around the same level for a period of time before reversing the trend with a downward gap. After the final gap, you can expect the price of the security to continue to move in the direction of the gap and can rely on this indicator to trade in the same direction. The volume should decrease when the first gap takes place, and it should increase when the second gap takes place and is reversing the trend. Continuous chart patterns. Next, let's talk about continuous chart patterns. Contrary to reversal chart patterns, in continuous chart patterns, the underlying security will follow a trend and will move in a certain direction. But once the chart pattern ends, the security will keep moving in the same direction. We'll discuss more about different types of continuous chart patterns, which will help you understand the concept that much better. First, we have the rectangle. We'll start with a rectangle chart pattern. It's fairly easy to spot a rectangle pattern. If you see two parallel horizontal lines contain the highs and the lows of an underlying security, that will be a rectangle chart pattern. You might also see a few people refer to these patterns as trading ranges, consolidation zones, or congestion areas. Bullish and bearish rectangular patterns might look the same, but you can find out the difference between both of them through the trend. In the bullish pattern, a stock price will rise to a certain level and then consolidate for a period of time between two horizontal parallel lines before finally breaking out above the resistance line or the upper horizontal line. What you'll notice is that the security breaks out in the direction of the previous trend and then continues in the same direction. Similarly, in a bearish pattern, the price of the security will first fall, then it will consolidate between two horizontal parallel lines before finally breaking out below the support line, and then it'll keep falling, thus maintaining its previous trend. In either case, the volume should increase when the price breaks out of support or resistance lines. If you see a bullish pattern, you might want to consider taking a long position in the market and a short position if you see a bearish pattern. Next, we have the wedge. A wedge chart pattern, much like a rectangle pattern, is easy to recognize. If you see two sets of lines converge or intersect, well, then that's a wedge chart pattern. You'll observe that the price of the security goes up and down at differing rates between the two lines, which gives it an appearance of a wedge as the lines approach a convergence. Now, in a bullish wedge chart pattern, you'll see the price of the security rise to a certain level. after which it will rise and fall at differing rates, which then gives it an appearance of a falling wedge as the lines approach a convergence. After consolidating for a while at the highs and lows between the two lines, the price breaks out above the upper line or the resistance line and then maintains the previous trend by continuously rising. You can use the same logic in a bearish wedge pattern. You'll see the price of the security fall to a certain level, after which it will rise and fall at differing rates while giving it a shape of a rising wedge. Finally, it'll break out below the support line and continue to fall, thus maintaining its previous trend. Now, as the wedge pattern takes its shape, the volume should decrease, but increase when the breakout occurs. If you see a bullish wedge pattern, take a buy position when the price breaks above the resistance line. If you see a bearish wedge pattern, take a sell position when the price breaks below the support line. Okay, now we're going to talk about triangles. Triangle patterns, and we can classify them in chart patterns by three types: ascending, descending, and symmetrical. Let's discuss all of these in a bit of detail, and we're going to jump right into it. You can determine which kind of a triangle pattern is being formed with the help of two trend lines or with the price of the underlying security. Let's start with ascending chart patterns. In an ascending chart pattern, you'll see two lines, a horizontal resistance and a rising support, between which the price consolidates at differing rates, although mostly in an upward trend for a while after rising from a certain level. An ascending chart pattern represents the bullish behavior of the security. So after going up and down for a period of time between the two lines, the price breaks above the resistance line and starts rising again, thus keeping up with its previous trend. Contrary to the ascending pattern, a descending chart pattern has a falling resistance and a horizontal support. Using the same logic, the price of the security falls to a certain point, and after consolidating for a period of time between the two lines, it breaks below the support line and then keeps falling, thus maintaining its initial trend. A symmetrical chart pattern has two lines as well: rising support and falling resistance. You can identify this pattern when the two lines, rising support and falling resistance, make a slope at similar angles to produce the symmetry. Although symmetrical triangle chart pattern is considered a continuation pattern, determining its direction is not so obvious, and it all depends on the trend in which it forms. You'll notice that it's bullish when the price keeps rising in a bull trend, and it's bearish when the price keeps falling in a downward trend. Much like wedge chart pattern, the volume should decrease when you see a triangle chart pattern take its form, and should increase with the breakout. A breakout or a breakdown with increased volumes is a confirmation to the end of the pattern and a great time to take new positions. If you see the price of the security rise in a bull trend, consider taking a buy position on the breakout above the resistance line in the ascending triangle pattern. And if you see the security fall in a bear trend, consider taking a sell position on breakout below the support line in the descending triangle pattern. Okay, let's talk about the flag pattern. The flag pattern, just like a normal flag, consists of a pole and a flag. The flag is basically a rectangle with two parallel trend lines. A bullish flag pattern begins when the price of the security rises to a certain high point. A low point, and it consolidates around that point at differing rates of highs and lows between two parallel lines. Now, these two parallel lines, as we know, are resistance and support, and if you observe it all carefully, you'll notice that the two lines will trend downward like a diagonal. These diagonal levels of prices create the pattern's flag. After a period of consolidation, the price breaks above the resistance line, and it's likely to continue in the same direction it was heading before. You'll most likely notice then a bull flag pattern in different sizes, but it typically will pull back at least 3 periods in consolidation. So let's say you're looking at a daily chart to figure out the flag pattern. The minimum number of periods in consolidation will be of 3 previous days. You can use the same logic in an hourly chart where the price of the security will be in consolidation for a minimum of 3 hours in the flag. Once you see the price break above the original diagonal resistance level, the pattern is complete and the security will find a new level of support. The breakout point is basically a buy signal, and you should consider taking a buy position in the market. With the same logic, you can determine a bear flag pattern as well, where the breakout point will be a sell signal for you, and you should consider taking a short position in the market. Once again, the volume should decrease once the flag pattern starts to take its form and should increase after the breakout. There's cup and handle now. And that's the last item on our bucket list, cup and handle pattern. As might be visible from the name, the pattern takes the form of a teacup with a handle, which makes it relatively simple to identify. A cup and a handle pattern is a bullish continuous pattern. On the contrary, an inverted cup and handle chart pattern would be a bearish continuous pattern. Now, in cup and handle pattern, you'll notice the shape of the cup being formed when the price of a security reaches resistance, and from that point, it'll start moving downward until it reaches the bottom of the cup, which acts as the support. If and when the price reaches the bottom of the cup, the shape of the cup will be complete, and from that point, the price will reverse direction again and will start moving up until the resistance. Once again, from the resistance line, the price of the security will move downward, but this time to a higher support than before, and then moves up to the resistance again. This will form the shape of the handle, and the size of the handle is typically 1/3 to 2/3 the height of the cup. When the price reaches the resistance from the support of the handle, you might want to wait until the price breaks out above the resistance, which will give you a signal that the price might continue to follow the upward trend. If and when the security breaks above the resistance, you can consider this as an entry signal and you can take a buy position in the market. However, you might come across a few investors who look for additional confirmation, such as high volume, before entering the trade. High volume at the time of breakout might indicate that investors are buying the stock, which can push the price of the security higher. With the help of cup and handle pattern, you can identify bullish investments that may continue trending higher. As you stay in the game, you'll come to realize that no price pattern is guaranteed to break out as expected. There will always be a risk that the price of the stock or some other security might fall through support instead of breaking above the resistance, or rise through resistance instead of breaking below the support. In such scenarios, you can always limit your losses through the use of stop loss and other techniques that we've discussed in risk management. Despite the risks, though, these patterns may help you identify potential buy and sell signals.